October 2023. The Fed hints at rate cuts. Everyone expects cheaper money ahead. So why did the 10-year Treasury yield spike to 5%? The answer isn't what the Fed's doing today, it's what the market fears about tomorrow. And it has a name: term premium. In the next 8 minutes, you'll learn 3 things Wall Street wishes you didn't know. 1. What term premium actually is. 1 sentence, 0 jargon. 2. Why it moves, and why your mortgage rate doesn't care what the Fed does next month. 3. Why good news sometimes pushes rates up, not down. Ready? Let's break the fear charge wide open. Here's the entire concept in one line. Term premium is the extra yield investors demand to hold a long-term bond instead of rolling over short-term bonds. Think of it like this. A 10-year Treasury yield has 2 pieces: expected short rates, what the market thinks the Fed will do on average over 10 years. Term premium, the fear charge, the bonus you get paid for locking in for a decade while inflation, recession, or chaos could strike. So if you see a 4% 10-year yield, maybe 3% is expected average Fed rates, and 1% is fear charge. Got it? Why fear charge? Because the longer you commit, the more can go wrong. Analogy time. Imagine you lend your friend $20 for a week versus a year. 1 week? Low risk. You charge 0 interest. 1 year? Anything can happen. Job loss? Move across the country? Ghosting. You want extra interest as insurance. Term premium is bond market insurance. Here's the mistake people make. People think if the Fed's cutting rates, all rates fall. Wrong. Simplified example. Fed's at 5% today. Market expects Fed to average 3% over the next 10 years. That means the 10-year yield should be around 3%, right? Nope. The 10-year trades at 4.2%. That extra 1.2%? Term premium. The market's charging you to take uncertainty off their hands. So what makes the fear charge go up or down? 5 drivers. Driver 1. Inflation uncertainty. Not inflation level, uncertainty. If everyone agrees inflation will be 2%, premium is low. If half the market says 1%, half says 5%, premium spikes. Driver 2. Rate volatility. When bond prices swing wildly, investors demand more yield to compensate. Think of it as hazard pay. Driver 3. Treasury supply. Big deficits mean the government floods the market with bonds. More supply, fewer buyers per bond, higher yield demanded. Driver 4. Fed balance sheet. QE versus QT. Quantitative easing. Fed buys bonds, sucks up supply, term premium falls. Quantitative tightening. Fed sells or lets bonds roll off. Supply rises, premium rises. Driver 5. Global demand and hedging costs. Foreign buyers love treasuries, but if currency hedging gets expensive, they demand higher yields to make it worth it. Plot twist. Flight to safety can compress term premium. When everyone panics and rushes into treasuries, yields can drop even if uncertainty is high. Fear of everything else beats fear of bonds. Okay, cool nerdy stuff, but why does your life care about term premium? Reason 1. Mortgages. 30-year mortgage rates track the 10-year Treasury plus a spread. If term premium jumps, your mortgage rate jumps, even if the Fed's cutting short-term rates. Reason 2. Stock valuations. Stocks are valued by discounting future cash flows. Higher long-term rates equals higher discount rate equals lower stock prices, all else equal. Reason 3. Government interest expense. Headlines scream, U.S. paying $1 trillion in interest. Part of that is term premium. Lower premium equals cheaper government borrowing. This is why yields can rise even when everyone expects rate cuts. Expectations fall, but fear charge rises. Net result? Higher yields. Ready to level up? Here are 4 insider details simplified. Insight 1. Term premium is invisible. You can't observe it directly. Economists estimate it with models. One popular model, ACM, Adrian, Crump, Munch. Different models, different estimates. It's educated guesswork. Insight 2. Forward rates lie. Market forward rates mix expectations and term premium. A 5-year rate 5 years from now isn't a pure forecast. It includes fear charge. Insight 3. Mortgage convexity amplifies moves. When rates fall, homeowners refinance. Mortgage-backed security holders lose their bonds early. To hedge, they sell treasuries, which pushes yields up. It's a feedback loop. Think of it like DoorDash surge pricing. High demand for hedging equals higher cost equals higher yields. Insight 4. Dealer balance sheets matter. Post-2008, regulations limit how many bonds dealers can warehouse. Less inventory equals less cushion equals higher term premium when supply surges. And here's the kicker. Good news can push yields up. Strong economy equals higher uncertainty about Fed path equals higher term premium. Counterintuitive, but real. Let's land the plane. 3 takeaways. 1. Term premium is the fear charge, extra yield for locking in long-term. 2. It moves with inflation uncertainty, rate volatility, supply, Fed policy, and global flows. 3. Yields can rise even when cuts are expected. Expectations and term premium move independently. Comment question: are today's long rates mostly expectations or mostly term premium? If this cracked the code, smash the like button. Subscribe for more market secrets the news won't explain.